Welcome, everybody. This is Geoff Dohrmann, and welcome to our first quarter 2026 ODCE Index update webinar. As you all know, those of you who have been joining us, but for the new folks, we're producing these on a quarterly basis to kind of give a little bit more depth of understanding of what's behind the numbers when it comes to the NFI-ODCE Index numbers. So many of you now are benchmarking on this index, and some of you, those of you in the private wealth advisory market, may be looking for a benchmark. And ODCE is the one that's primarily used by institutions around the globe when they're trying to benchmark the returns of their portfolios in the U.S. market. So hopefully this will be instructive and helpful. Just to refresh everybody's mind, we're recording these sessions. You'll get a link afterwards to the recording. So you don't have to scribble and take notes. You'll be able to look at it later if you want. We also have a facility to handle your questions. So if you have a question during the webinar and you want to direct them to our speaker, just pop down to the Q&A icon at the bottom of your screen and plug it in, and we'll do our best to get those questions raised and answered for you during the course of the seminar. So great, glad to have you all with us. And without further ado, allow me to introduce our speaker, Garrett Zdolshek, who is the portfolio manager for IDR and the Accordant ODCE Index funds. All he focuses on is ODCE. So there's probably nobody better qualified in the industry to provide this kind of an update. And we really appreciate, Garrett, you taking the time and having your staff invest the effort in putting this all together, because we know it doesn't just happen by itself. So welcome.
Thanks, Jeff. By the way, Jeff and I saw each other last week, and he reminded me that I don't smile enough on these. So I'm going to try to smile and have a little more fun. I do really enjoy doing these, and talking through the market. And in particular, I love the questions. So please ask questions. It always gives us new ideas of things to talk about, slides to put together. Trevor, who's always joins us, does a great job putting this together every quarter. So, please keep the questions coming. Love the dialogue, and we'll get into the main presentation here. But as we go, please again keep the questions coming.
Oh, someone says there's an echo. I'm not sure where that's coming from, but I'm going to mute mine. Might be coming from me.
But yeah, see if that keeps going or if that's someone else's echo. But I certainly don't hear it. But let us know if it continues. So we'll cover a pretty traditional agenda. Start with an update on ODCE, market overview, just generally things that have changed or staying the same. Then we'll dive into fundamentals, and there's a lot to talk about, I think, in fundamentals today, as we really think that is what's going to ultimately impact returns and drive returns going forward. And then we'll end it with capital flows, both in terms of the asset level, what's being bought and sold, as well as the investor level at the ODCE fund level in terms of inflows, outflows, amounts, Q payments, et cetera. So let's start with the market overview. The traditional view, not a lot has changed. Few less properties. Occupancy is down a little bit, primarily driven by office. 25 funds, that has remained relatively stable and unchanged for quite a while. Maybe a new fund coming in next year, we hear. And then leverage slightly ticking up again. It was moving on its way down a little bit from high 27 range to low 27 range, but again, very manageable, relatively unchanged. From a property type perspective, again, we remain heavily exposed to the industrial residential areas. Office is flattening out a bit, and retail it remains relatively unchanged as well. Self-storage, you'll notice, continues to creep up along with other and breaking out the self-storage from the other. I would also mention, though, that, and we covered this a while back, there are a number of subtypes or categories that used to be in other that are now in the main food groups like residential and office. For example, office, life science is an office now. It's not broken out in other. So there is some nuance to these bigger categories as they are now encompassing more of the subtypes that were traditionally allocated to the other bucket. Crystal clear, I know. Geography, again, relatively unchanged and continues to be weighted to the west, with more south exposure and the Midwest continuing to decline. Again, I mentioned on the property type side, the office is down 18% from 2019 and down significantly from its peak around 40% in the 2015-2016 range. Industrial seems to be flattening out a bit, and I think that's largely being driven by fundamentals, which we'll talk about. Residential continues to creep up a bit, also kind of driven by some of those subtypes within residential in particular. And you'll notice retail has really leveled out and maybe even start to creep up a bit again here. And then finally, self-storage and other, we continue to see those exposures move up a bit as well. From a return standpoint, and this I think has been on everyone's mind, we're coming through a pretty slow and muted recovery. Although 1Q26, and I had to fact check this, 1Q26 was the first time we saw the net total return exceed 1% in a very long time, 4 years to be exact. So I think a encouraging green shoot, again, seeing returns start to come back towards normal.
Somebody has a question, Garrett. Where did the data centers reside in that whole mix?
Sure. So data centers are in the gray line at the bottom, other, and they're less than 1% of the index today. The majority of data centers are effectively development deals these days. I know some are starting to come online and be stabilized and whatnot, but there's very little stabilized data center in the index to begin with. And then I think secondly, it is such a big asset class in terms of capital needs. Data centers tend to be a little heavier leverage or LTV. So again, tend to not have a lot of, unlevered data center exposure when they're $1 billion a piece to begin with, if not more. Coming back to, the returns and the asset class.
Another question before you go on. Somebody asked, I assume medical office would be an office as well as you mentioned life sciences in that book.
So medical office, yes, medical office is now in the office category. For many years, it was considered an other property type, but now it is considered a part of the office subtype. So going back to asset class returns, and I always like to keep the perspective, where does real estate sit, in the broader, investor pie, right? Because real estate tends to be, anywhere from 5 to 15% of a portfolio, depending on who it is or what it is, what the investor is. So, it's important, I think, to keep some relative views. The by and large story is equities have been the place to be for the last 2 to 3 years in particular. You see 1Q equities started selling off maybe a bit, but it feels like we're probably back above, the peak again, depending on which index you use, using S&P here. But Certainly, as an asset allocator, it's been tough to not want to stay allocated to equities given the run and given the, returns generated, which, have really been unprecedented in this cycle for equities. I can just say, we certainly are feeling more and more flow starting to come back to other sectors, having a lot more conversations around, rebalancing to targets, how underweight should I be to real estate again going forward, but when are the returns coming? It's really hard to time these things. Certainly understand the desire to allocate into a higher return strategy. But I think we're starting to get to this asset allocation place where investors feel like they're maybe too underweight real estate again, which hasn't happened in a while. So certainly seeing more flow across our platform. The first half of this year effectively, has been more than what we saw all of last year in terms of new allocations and new flows. And I think that's going to continue. But I think it's important to keep in mind what the total returns will be and when they'll kick in. So we'll talk more about that in fundamentals. I think the other thing to point out here is maybe, ODCE compared to REITs, so public and private markets are showing, they're more or less agreeing with valuations today, with pricing. So again, another positive sign, that we are finding the right values, on both sides of the market. Longer term, again, I think, real estate should sit somewhere between stocks and bonds. From a return perspective, longer term, it continues to sit in between. It's closer to bonds today than stocks. But over these cycles, that will move, and this is certainly the longer term cycle. I think, while it's been a good place to be, in bonds over the last few years, and certainly that 60-40 portfolio has done really well. I think we've also seen periods where it doesn't do as well. And, if stocks don't continue to drive that portfolio, I think we could start to see, a more accelerated reallocation to private markets again. Mentioned the cycles, and the title of this presentation was, are we in a new cycle? It certainly seems like we've really, slowly eked into this new cycle. It certainly hasn't been as fast of a start as prior cycles, but I think we're clearly now into this better part of a positive return cycle. Last three, by the way, have been remarkably similar. If you look at kind of leading up to the 90s, then leading up to the GFC, and then this last third cycle leading up, to COVID, each of those cycles has been about 15 years, plus or minus a year. And the returns on a cumulative basis have been anywhere from 170% to 190% of the starting point. So three cycles have been remarkably similar from a timing perspective, meaning duration, about 15 years, total return perspective. But you can see to get there, over those 15 years have always been a little different. Some start out a lot stronger. Some, take a while, like the 90s, to build up, but then end stronger. So I think, no cycle is ever the same, but they tend to rhyme. So when we look at this versus the last two, we're kind of right in between. Right in between the 90s and the GFC from a drawdown, drawdown about 20%. And then from a recovery standpoint, this certainly looks a lot more like the GFC, or looks a lot more like the 90s than the GFC, where it's kind of been a much slower, steadier climb out. And we'll talk about some reasons why again in the fundamentals area. From a component fund or a index constituent return perspective, I think the outliers and the downside continue to compress here for the last two quarters. So you can see The lowest performing fund was just barely negative this quarter. And incidentally, there was only one, slightly negative fund performer this quarter. So again, we're seeing less negative return, less bad news, more positive returns. And you can see the kind of average is a lot closer to the top performing fund this quarter than the bottom. Again, more consistency, I think more clarity on the outcomes and the valuations. I mentioned, some of the drivers of return. So this slide is showing two things. The first, the blue, is just the dispersion of return, or the best performing sector versus the worst performing sector on a rolling 1-year basis over all time periods. And then the green is showing the best performing ODCE fund versus the worst performing ODCE fund, again, over a rolling 1-year period. And you can see the green really spiked in the GFC. So the dispersion of return among funds, when there was a lot of volatility in the financial crisis, was really high. Notice, though, the property type return dispersion was really low and actually below average. So we saw a lot of total return dispersion, but it wasn't driven by property type. It was really driven at the asset level by quality, tenants, credit, things like that. So fast forward to this cycle, and you can see the property type dispersion actually went above the fund dispersion. So what you own, meaning if you just broadly owned, for example, industrial and underweighted office, meant your portfolio probably did a lot better. If vice versa, you own more office compared to the benchmark, you probably didn't do as well. So, there was a lot of property sector driven dispersion. Add life science to that category and some other alt sectors. Certainly on the upside, data centers right now are driving the higher returns. So, I think we saw a very different cycle from a asset level up this time around than last time. It also makes it really hard to judge performance when it's all asset allocation versus asset selection. So we are moderating. I think 25. If you look at the end of 25 and into 26, we saw the fund dispersion come down slightly below average even. The property type dispersion came down below average, and then the fund dispersion is, slightly above average, but much more moderated than before. So part of this is cap rate, right? ODCE cap rates, I think, have been stubbornly around the 4.5, 4.6, 4.7 cap rate range for quite a while now. And they really started moderating into 2024 and through 2025, they really flattened out, right? Not a lot of change. If we look back, that coincides a lot with interest rates leveling off and starting to come down as well. I think as you look at some of the nuances, certainly on the top office, you can see the cap rates are coming down, but that's more driven by lower incomes or rents and tenants occupancy. There's some just base value of land and assets that I think where cap rates stop making as much sense, and I think we're certainly in that phase with office. Although seeing maybe a few green shoots I'll talk about in a minute. Retail remains, a very attractive, I think, income producing level, in particular grocery anchored. And then you'll see in the bottom, industrial continues to edge its way up, which is really a function of mark to market on leases. So as leases come due, new leases are signed at market rates. That's driving incomes up really more than cap rates are moving, if you will.
There's a couple of questions here, Garrett. One is cap rates today's value divided by NOI or yield, or new acquisition cap rates?
So these cap rates are, and again, I think this is a really important topic. We probably don't spend enough time on this. Um, I think these cap rates are current value divided by 1 year forward NOI. Okay. So it's a very specific number. It's very apples to apples. This is not based on 5 year, 4 year, anything else. And I think we are often misquoted, you know, this cap rate number versus, hey, when you do an acquisition, you're certainly looking at, a 5 year pro forma, discounting it back, looking at kind of cap rates, over that whole period and kind of averaging it out. That's a very different number. And I think often why that number is misquoted against these lower kind of near-term cap rates. So again, we could probably spend a whole session on this. I would really suggest people spend some time thinking about what methodology and what numbers, you're really using when you take a current value over what, NOI over what period. From just a value perspective, so again, this is just write-ups or write-downs at the asset level, if you will, unlevered. This is by number of assets, although it's not very dissimilar to by if we look at it by NAV. More write-ups, right around 50% of assets are being written up. Not a lot, but slight, value increases. Again, kind of that middle ground of yellow, a fair amount of flat, and then, it's about 30% plus assets being written down. Again, I think a lot of the driver of these values today are, new leases, NOIs, being kind of driven up on the green side, and then certainly, an office, for example, tenants leaving or more vacancy, driving values down. But I don't think a lot of this is today cap rate movement either direction. It's really more a function of operating outcome at the asset level today. And overall, again, we're kind of plodding along here. I kind of focus on a couple colors here. Leading up on the upside, the industrial in blue and apartment in green, saw really outsized returns relative to every other sector, in the good times. Then on the downside, saw an early correction really in all three sectors, whether it was apartment, industrial, or office. But a lingering effect, I would say, from apartment and especially office, through the negative return cycle. But now, all three sectors, and you even see a little of, I guess, purple there in retail. All 3, 4 sectors are really kind of, weighted to their exposure performance-wise at the moment. So, that 1% return was not driven by one sector anymore. And it really took all 4 sectors to start producing some at least positive or slightly positive return going forward. And again, this is all unlevered. So, a reminder, when you're talking about the returns we're talking about of 1% a quarter, that's 4% annualized. Debt still is not accretive, even in core, cost of debt. So, we're inching up to where we're going to start getting some of that, afterburner effect of leverage impact, but we're not quite there yet. Internally, so we always joke, this is kind of like the slide where everyone sees something different. What do you see in here? We can talk about this for a while. We can do it annually, quarterly. This is quarterly. And I just kind of focus on a couple interesting things in my mind, but I'm sure you all see different things. One, on the bottom, office is no longer, consistently, the worst performing sector. I think that's a bit of a green shoot. You'll even notice in the last 2 quarters, it eked up above the ODCE average. Kind of interesting, I think. I think we are left kind of with retail story. We're kind of left with some of the better, stuff you want to keep. A lot of the bad has kind of been flushed or, sold or given back or whatever you want to call it, but it's not in the index anymore. I think secondly, if you look at the top, the most recent performers, you see a pretty good run of purple with retail. Self-storage in green, kind of went from middle of the road and it's now up there in the, top or second spot. And then, finally, industrial in the blue, really over the last 4 quarters, we've seen industrial underperforming the index as well. We haven't seen that for a long time. So I think some of these are trends, some are probably not. I don't want to get overly, pessimistic on industrial, for example. I do think industrial, recalibrated a bit, and is probably poised to come out of this. But, a lot of different things happening over the past year, I think, against kind of the norms we felt over the last 3 or 4 years. Anecdotally, I would say I think investor reaction is still I want industrial and apartment, whether the returns justify it or not. Because I think they're still looking about it, going forward, not necessarily over the last year. So the main sectors dispersion has come in. Performance is more consistent, if you will, across the board. But I think among the alternative sectors, and again, this is whether it's subtype or true other, we still think of these as the alternative space. We are seeing a very wide outcome of performance. Again, I think on the left, data center, that's been there for a little while, but data centers, while a small percent of the index today, I think it's probably a bigger percentage of investor portfolios than that, on the risk spectrum in the non-core space. Again, 1 year trailing unlevered returns at 19% is pretty astronomical. So certainly really strong returns out of data centers. They're in the news every day. I'm not going to get into too much detail there, but kind of a newcomer, I think, is senior housing. Again, a very small component of ODCE. It feels like this is the third time around in my career where senior housing has become the kind of topic of demographics, and now is the right time given demographics. Heard that twice before, so I'm a little skeptical, just given how each time the demographics were showing a clear runway for the next 30 years and didn't really turn out to be that way. Ran into some different challenges. I do think it's a very heavy operating business. So again, I think you'll probably see a lot of winners and a lot of losers because of that. But again, two very clear double-digit winners today in data center and housing. It really falls off from there into the single digits. And then you see again on the right side, further life science, decline. And I think just shows like not every subsector or every alternative sector, is right for core or will be a winner necessarily long term. Okay. Going to switch around over to fundamentals and maybe hopefully, talk about some of the more detailed drivers of these returns and past and in particular future. So Fed meeting tomorrow, new chair. Markets aren't anticipating a hike at the moment, I think, from a consensus view, but this sentiment has certainly shifted from, more rate cuts to either flat or rate hikes going forward. Obviously, a lot of change in inflation again with the war in the Middle East. I don't necessarily purport to say that I understand how rising rates will lower oil prices, but that's topic for another day. Um, Other than I think, we've gone from hey, inflation is under control to should be worried again. I think on the other side, unemployment remains relatively strong, but showing some moderate signs of weakness, trending up slightly, from the lows in 23 and 24. So I mentioned, and cap rates are certainly very sensitive to inflation and to interest rates. In particular, you'll see, I think that cap rates effectively started flattening out once we got a handle on where the Fed's funds rate were. Started seeing a bit of a, decline or tightening of the Fed funds rate, which led to, the cap rates flattening out. And while there is a Fed funds rate spread today, there's certainly very much even lower, if any, spread to the 10-year Treasury, right? We started feeling pretty good about things when the 10-year Treasury was around 4 and actually dipped slightly below it at the beginning of the year. I think we'd feel differently now that or that the 10-year went above 4.5. Although again, I think that's moderating a bit. So I think something to keep an eye on. The other thing is, I think, how much cap rates are driven by interest rates. So when we looked at some prior cycles, we wanted to look at how much of cap rate change was attributable to declining interest rates. Or I'm sorry, how much value was attributable to declining interest rates, or how much value was attributable to cap rate movement. And so when we looked at this, in the periods where we saw cap rate, expansion cycles, about 87% of the cap rate spread expansion was because of declining interest rates. So this is a really long way of me saying we don't think cap rates are going to drive value creation going forward. In other words, cap rates going down make values go up appreciation wise, but we don't see interest rates being conducive to driving cap rates down. So we're then have to find some other sources of return beyond just financial market valuations going forward. I think that's pretty well viewed across the markets today. And so what do we think, are some positive signs, and what is in our minds going to drive some value? I think first is really replacement cost. So the value of an asset today that you can buy is, in our view, cheaper than what you can build it for. So long term, we think that sets up a really good, entry point for values, given that if you can buy it today today it suggests we're about 17% below replacement cost. But again, if you can buy it cheaper than you can build it, you should probably buy it. I will caveat this with, I think this applies a lot more to newer assets. So, assets that are modern, 5 to 10 years old, for example, versus assets that are, 30 or 40 years old and obsolete. Different rents, different tenant profile, probably different valuation. I think also from an entry point, the appraised values, so NCREIF, ODCE appraised values, next to market prices of Green Street valuations, public markets. Again, I think valuations are agreeing really heavily today, and this is adjusted for property type exposure. But if you look at that, we believe public markets, private markets are largely valuing things pretty similarly again. I think a while back, we announced a partnership with Cohen and Steers to take advantage of, the mispricing that often happens in the public and private markets. So we really saw a run up in we saw a run up in public market returns, over the last quarter or so. We really think that was justified and much more in line with, I think agreeing with private market values as well. That that replacement cost and valuation perspective, I think, it comes down to supply and demand. So new supply is significantly off its peak, down 54%. And again, I think, around 0.5%, 1% new supply growth is really just taking up obsolescence. So the market has said, it doesn't make sense to build a lot right now, and it's clearly reacting. Uh, Incidentally, I think, when you see this new supply, construction come off so heavily in the commercial markets, you typically kind of see much more impact in employment and the broader economy. I think the difference here is, a lot of this construction and commercial activity has gone over to data centers, which isn't really being tracked here, right? So, saw a great chart the other day that basically showed new construction and things like data centers has more than made up for the lack of new construction of traditional assets, in the commercial space. I think secondly, then, as the new supply has come offline on the right, we should expect rent growth to kind of pick back up as the new supply is absorbed, should create some more pricing power for landlords. 2025 was negative, along with 2024. That really muted the performance in our minds of assets, and that return generation going forward. But we are starting to see that pick up again. So really planning on seeing rent growth drive NOI, drive valuation going forward. And again, I think you generally do see NOI growth keep up or even surpass inflation in a lot of places, but it's not always one-to-one. It's not always perfect timing. So we've seen inflation kind of level off, around 3% and slightly tick up recently, but you'll notice rent growth or NOI is severely lagging that for the moment. It is starting to show some signs of coming back, but over the last year, it's really lagged, and I think again driving that slow value increase. So that was a trailing 1 year. This is quarter over quarter. You can see it dipping down to effectively zero over 2025, and now starting to tick back up a bit. We expect industrial and resi to really drive that going forward, along with retail. I mentioned cost of debt. So, as ODCE cost of debt is around 4.5% today, heavily weighted to fixed rate debt. 75+% of the debt is fixed rate. That's obviously pretty moderate, around 27% as well. So it doesn't have as big of an impact maybe as, as debt does across the broader real estate universe and the higher leverage strategies. But we do think, cap rates, while it'd be great if they stabilize maybe a little bit higher than this today, we do see a very high correlation to when cap rates stopped expanding and when debt, yields started kind of matching the cap rates. So I think over the next few years, we're going to need to see that NOI growth, which will help, cap rates effectively expand with and values go up as well at the same time. Maturities, I won't spend a lot of time on this, but again, maturities are real staggered, weighted out over time. So we don't expect a lot of this kind of reborrowing or rolling of borrowing to be a big topic. Certainly hearing about it in the market to a degree, but it seems to be pretty orderly absorbed at this point. All right, so last section, capital flows. We'll start with the property level. So 1Q26, first time in a while, we've seen more buying than selling, but pretty robust selling as well. So I think, coming off end of last year, number of managers really making a concerted effort to start selling more. values are aligning with marks. And I think we're continuing to see that. Certainly the surprise of the war in February didn't help, but fairly robust selling nonetheless. In terms of the selling, it was pretty evenly split among industrial and residential. And then, office continues to, I think, selectively be sold as it can. On the acquisition side, uh, I think a lot more apartment in general and resi, including some of the subtypes, so not just apartment. In fact, I think a lot of the subtypes drove a lot of that new resi acquisition. Uh, Industrial second, and then third, the 22%. These colors are a little hard. The other, but that was primarily senior housing, I believe. So broke it out here to show you like senior housing. If you think about senior housing and resi, it was, big place to be for the acquisition space. Net investor cash flow. So this is total cash flow uh, coming in or out of the index as a whole, whether that be income distributions or redemptions or reinvestment of income and new commitments. So everything in and out. You can see continued negative outflows, around $2 billion of outflow, pretty consistent with the last few quarters. But you can also see, a fairly robust inflow as well, around $2 billion. And I think that's helpful from a rebalancing and from a redemption standpoint. So redemptions continue, and so this is Q as a percentage of NAV. Redemptions continue to work their way down, just barely above 10% today. And again, I think we expected maybe even a little bit bigger pause with the war. Certainly tariffs added that kind of disruption and that nick in the line last year in the first quarter of 25. But really kind of business as usual with the war in terms of these cash flows, continued redemption payments. At the fund level, again, I think the funds are really kind of ramping up those redemption payments, over 10% again this quarter. Certainly much better than the kind of 23, 24 time periods where they were closer to 3 to 5%. So cash flows are ramping up, payments are being made. I think probably, as we look back, we wanted to say, like, what is the biggest impact? Why isn't it going faster? And so when we think about the impact, we looked at a couple things. So the investor impact are effectively new requests. So if new redemptions come in the quarter, as well as rescissions, right? So an investor can kind of control that impact. And then the blue, the fund impact, effectively are fund, redemption payments. So asset sales, or taking in money and paying out the old money. So, again, I think we're seeing the black dot is the total impact, where Qs were paid down in the first quarter, $1.5 billion or so were paid down. But that was pretty heavily impacted by new redemption amounts. So over, I think it was almost $2 billion in new redemption requests came in the first quarter, partially offset by rescissions, but nonetheless over $1 billion of total new requests came in relative to rescissions, and then the pay down. So you can see why it's moving a little slower than we'd like, maybe, as the new requests come in. It's kind of keeping that redemption queue elevated a bit. Although, again, I would say these are averages, and it's very important to kind of keep in mind averages are, just that. They don't really tell the whole story. So there's some elevated queues still today, but there's also a handful, maybe a half dozen to a dozen funds that are, at or very close to paying down their total redemption queues. So we are very much in that transition. I think evidenced by the acquisitions versus disposition chart. We're starting to see people in certain cases buy again, which is positive.
Garrett, there's a bunch of questions, so I want to hit you up with them in sequence if I can. The first one is how much of the capital that's coming in is coming from domestic U.S. investors versus global international allocators? And has that mix been shifting recently?
That's a great question. We don't track sources of allocators, but I can tell you anecdotally, it feels like there's probably renewed appetite or more buying in Europe again, and more capital coming in. And this is anecdotal, so experiences may differ here. um, but it does feel like we're seeing more European money come to the States again. While at the same time, it does feel like more Asia investors are selling, reallocating, maybe going up the risk spectrum too, as a lot of there's been a lot of volatility among currencies, and with the interest rate movements, hedging costs have been vastly different by market. So I think there's been a lot of cycling in and out just broadly, among U.S. and foreign investors.
Okay, and there's another question that I think you already answered. Do inflows or reduced outflows include the effect of redemption rescissions? And I think you said yes to a certain extent.
Correct. So investor impact is commitment, redemption, and rescission.
And then another question is, are redemptions skewed towards some key funds or consistent across the universe of managers?
Yeah, I think it's still very fairly broad, but certainly, if you look at, there's a high correlation between performance and capital flow among funds. Not necessarily one for one every quarter over quarter, but over the longer term. And then I think there are certainly funds with no queues today, and then there are funds with bigger queues today. So it's across the board.
Another question has to do with secondary market activity. Has there been uh, an uptick in secondary market activity? What's going on in that area?
Yeah, so I'd say it's been quite robust. The bid ask really came down, meaning I think last year or last over 18 months, I think sellers were pretty realistic about them needing or wanting liquidity for various reasons, and it's always a very specific reason. So I kind of hesitate to kind of say this is a market that is a tight spread, right? Because there's only so many buyers and there's only so many sellers. It really comes down to a function of who can agree to a price together or not. So, we often see different funds trade at very different prices based on amounts or specific timing needs, other things. But I will say the market's been fairly robust, which tells me again, kind of like valuations with public and private getting closer, buyers and sellers can agree on pricing better today, and have opinions on it better today. So, pretty good. I think we've probably seen the peak, but it remains relatively robust. We're a pretty, active participant there.
And another question is, do you see a time when ODCE funds will return to normalized client activity, i.e., no redemption queues? And if so, what does that time look like? I realize you don't have a crystal ball, but what do you think? How long is it likely to get to the point where the redemption queues are gone?
Yeah, look, so I mean, and by gone, I think a couple percent is even more normalized in and out, right? Like you can see the blue was significantly higher than the orange for a really long time. And again, I think it comes down to asset allocation, need to be allocated. I think perspective on return and view of return going forward. So, as we look at this, I think the line's fairly steep coming down. We expect that to probably continue, but the way the line really accelerates is when new requests stop. And so, give me a period, I would say, where we don't have major macro fundamental changes like tariffs last year, and then the war this year. And I think we can all, and by the way, before that, obviously COVID, like what is normal anymore? I don't know. But if we can get to normal, I'd certainly love it. I think a lot of us would love it, right? Like this has been a very protracted cycle on the downside. We're not out of it, right? We're still not back to normalized returns. But I think we can kind of continue to see better and better green shots, right? Hopefully the Middle East is, settling down. Hopefully interest rates and inflation will settle down with it. And again, I think these are hopes. So, we're not, you can't plan for a hope, but at the same time, I think the capital here is pretty stable, pretty patient, and the debt is not driving decisions, right? It's the investor return outlook. So I remain pretty optimistic. I think, markets will settle down in terms of kind of the geopolitical inflation, interest rates, hopefully will follow suit. At which point, entry point seems really cheap to me when you can buy something for almost 20% cheaper than you can build it. That seems pretty good to me. I think that along with, new NOI growth kind of gets you to a pretty decent return over the next few years. I just think the early years are going to be slower than the latter years.
Okay. Thank you.
All right. Well, I think appreciate all the questions. I think we're a few minutes early today, but as always, it was great. And if you have any follow-up questions or anything you think we should cover next time, please email me. Feel free. Always love your ideas and questions.
Oh, and what we can do to kind of close too is let people know when the next sessions are going to be recorded. The next webinar is going to be September 22nd, and then that'll be followed by one on December 10th. So you can mark those in your calendar. Again, September 22nd and December 10th.
Awesome. And as always, thanks, Jeff, for having me. Always enjoyed this.
Yep. Thank you, everybody, for tuning in. I'd get back on screen, but my internet has been down. I've been doing this by cell phone. The joys of modern technology. Have a wonderful summer, everyone, and we'll see you on September 22nd, if not before.